Good morning to you all. My name is Roberta Consiglio, and on behalf of LuxFlag, I'm very happy to welcome you to the next session of the LuxFlag Sustainable Investment Week 2022. Next presentation will be on artificial intelligence in ESG and is hosted by FactSet. For that, I'm pleased we have it with us today Mr. Fabrizio Spagna, Principal ESG Specialist at FactSet. In this role, Fabrizio offers ESG expertise and solutions to asset managers, asset owners, risk and compliance teams who are looking into integrating sustainability goals into their investment workflow. Fabrizio, the floor is yours.
Hi everyone. So today I'm going to be talking about artificial intelligence in ESG, the why, the where, and the when. But before I do get into the nitty-gritty of what I'm going to be talking about, I'd like a show of hands from anyone here who's currently using AI in their ESG or investment processes. Okay, so 2 of you. So yeah, all right, fine. So usually a little bit of a higher response rate, I would say, but it's fairly in line with what I would typically expect. And I'll explain why I asked that question in just a moment. But before I do so, I just want to introduce FactSet a little bit, just to add some context as to why I'm here. So FactSet, if you don't know, is one of the largest data vendors in the industry. We have 10,000 employees across 20 different countries. And from the ESG perspective, we have 2 main lines of business. The first is our own proprietary data, which you can see here. So for example, True Value Labs, which is heavily reliant on AI, PAI data, and a number of individual non-ESG focused data sets, which can be used for things like eligibility and other regulatory requirements. But we do know that we're not going to tick every box for every client. So we do also partner with a number of established third-party vendors, some of whom you can see on the right-hand side there. Not sure if anyone in the audience is actually from these vendors, but some are ESG generalists, some are focused on the E, the S, or the G. And the reason that people ingest those data sets through FactSet is that we clean that data, quality check that data, and then give them a kind of one place access to analyze, aggregate, and slice and dice those data sets. So it wouldn't be a presentation if I wasn't showing off about our awards. So you can see here, this is about our True Value Labs product, Best ESG Data Provider of the Year, Best ESG Data Provider, and a number of others in 2022. So that's the sales pitch done. So what is AI in this context? So a few moments ago, I asked how many people are actually using AI at the moment. And not many of you are. And that's not hugely surprising, to be honest. Because I talk to a lot of asset managers, wealth managers, private banks, hedge funds, the sell side. And there are typically 2 reasons that people give for not using AI. The first is, well, people are actually not sure it's going to add any value. So, if something's not broken, you don't need to fix it, right? The second reason is there's almost a fear and a concern around using AI, in that it's going to change the way that you look at things. It's going to tell you what to think. It's going to, in some way, disrupt your workflow. It's going to give you another thing to look at, right? So for those of you who do have those concerns, I have some good news, and that is that AI in this context is not this. So you're not going to get Arnie telling you that you can't have your morning coffee. He's not going to tell you what to think. He's not going to tell you what to look at. Instead, AI in this context is what we call natural language processing. And artificial intelligence generally is really designed to mimic, in many ways, human abilities, right? So many of you on your phones will have facial recognition software, which is designed to look and recognize your faces in the same way that you and I would be able to. Natural language processing is really designed to do the same thing, but in trying to understand written and spoken language. So humans make decisions in multiple different stages. And for anyone here who's interested in learning more about how we interpret information, how we deal with information as people, there's actually a great book called Thinking Fast and Slow. I'd highly recommend it. But in essence, there are two stages to the process. So we have a fast mind, where we make an immediate decision, a subconscious decision, based on whatever stimuli we're faced with, right? So if I'm in a situation, I need to know that it's not dangerous, or if I'm reading something, I want to know what that piece of information is actually telling me. So I make an immediate reaction. The second is we have a slow mind. And that's where we consciously think through what we're being faced with. So if we're reading something in a book, we actually start to think, okay, well, what does that paragraph, what is this actually trying to tell me? And then, of course, we use our own knowledge, our own biases, our own expertise, if you will, to come out with a decision. Well, natural language processing is not so different. It follows not this exact path, but it's a number of different tasks which are designed to identify and process information much in the same way that we do. So if we start off with our sources of information, the key here, much like for us, is to have a source that is of the utmost quality, right? You want a high quality source, because if you put something bad into any systematic process, you're going to get a bad decision out of it. So you want a high quality source to start off with. So let's say here we start off with an article. What you want to do with that article is then you want to identify, okay, well, what entity, who or what is the subject of this particular piece of information? So that's when entity extraction comes in. And entity extraction is just a fancy way of saying, subject identification. So it could be me, it could be a company, it could be Microsoft, Google, Apple, whatever it is. But here we want to identify that subject. Now this sounds fairly straightforward and simple. In reality, there is quite a lot of innovation that goes on here. And you can imagine that there's some complexity around identifying, or systematic tool, identifying things like Apple the company compared to Apple the fruit, right? Or when you're looking at private companies, where there's not so much data, you need to make a decision on, or you need to identify company names which are not so distinguishable. And you don't have a large data set to train your algorithms on. So there is some innovation that goes on here. The next task, if you will, is topic classification. Now, this is where I would say it's absolutely crucial for anyone who is thinking of using AI, or anyone who is using AI in their workflows, to make sure that whatever AI tool you do use is designed and trained for the specific purpose that you're going to use it for. The reason I say that is there are a lot of great AI tools out there, right? Great generalist AI tools out there. Looking at financials, they're looking at ESG, they're looking at a number of different pieces of information. The problem with that is you immediately increase the likelihood that you're going to capture information which is not relevant to what you're looking at. And secondly, that you are actually going to miss things, which is potentially the more damaging and potentially the more risky thing. So you want to make sure that the tool is designed for sustainability, it's designed to look at regulatory information, it's designed to look at the financial impact of ESG, and so on and so forth. So let's say we've started off with our article, and then we know the article is talking about Microsoft. At the topic classification layer, now what we're looking at is, okay, what else is the article talking about? So let's say now we identify that the article is also talking about modern slavery. So we know that we have an article, it's talking about Microsoft, and it's talking about modern slavery. The next task or thing that we want to do is associate these two things, right? So we want to associate that Microsoft is being spoken about with modern slavery, rather than both being mentioned in abstract. So that's what we do at the entity and topic association layer. But what we don't know yet is whether that association is positive or negative, and how positive or negative that association is. So that's what we do at the final stage, really, at that sentiment stage. This is equivalent, if you will, to that slow thinking, that conscious, I'm not saying AI is conscious, but that conscious thought process that we have, where we're trying to make a decision based on the information that we have, and try and identify an outcome, a kind of tangible data point at the end of it that we can kind of rely on. So this is an example or visual example of what that can look like. So we have an article on the right-hand side here, and we start with our source at the top, and then we have tagging of multiple entities. So you can start to see where the complexity comes in here, right? We're now not only just talking about one entity, but we now have to identify multiple entities. The next thing is we're looking at a number of material and non-material categories. So we now need to somehow identify, okay, what is material? And is that material for this company? And is it, material for all companies? And so you can see how this becomes a lot more complex in a real-world setting when you're looking at multiple entities, multiple subjects, and multiple topics of conversation in one piece. And then, of course, you need to identify, okay, well, what does this actually mean? Is it positive or negative? And what are we actually talking about here? But AI has been around for a long time, right? So I'm not here, teaching you things necessarily that you don't know. AI, even in ESG, has been around for 10 plus years. So why am I bringing this up now? Why are we talking about AI at this specific moment? Well, I think there's a very strong chance that we're headed for a perfect storm. Now, for anyone here who looks at risk, or to be honest, even in day-to-day life, what you'll usually find is that negative events very rarely happen completely out of the blue, right? Typically what happens is it's a number of small events that increase the likelihood of that big negative event actually happening. So, for example, if we take the Boeing aircraft accidents a few years back, it's obviously on a systematic basis almost impossible to identify or understand that a plane is going to crash. But what you can do is you can see that, okay, the company is under commercial pressure. The company is not communicating well with its clients about new features. The company is also not following its own governance procedures. And when you add all of those things together, what you get is a significantly increased probability of a negative event. I think that's what we're facing here at the moment in the ESG space, but also in the industry just more generally. The first factor that I think is contributing to this potential perfect storm is inflation. Now, I don't know what it's like here or in Europe generally, but in the UK, you literally cannot go anywhere without someone talking about inflation. So a few years back, if I wanted to maintain the real value of my money in the UK, all I needed to do was hit a kind of return of around 2%. Not so difficult to do. If I want to do that today, I need to hit a return of 10%. The only ways that investors are doing that, or the main ways that investors are doing that, is either by investing into riskier assets, so onboarding more intrinsic risk, or onboarding more leverage, or a combination of the two. But whichever way you look at it, we have a situation where investors are onboarding more risk across the industry. And I'm seeing that in a lot of my conversations. The second potential contributing factor here is that we're in a cost-cutting environment. And for those of you who were here yesterday, you'll have heard some of the biggest asset managers in the region talking about them having an analyst team that is not covering all of the companies that they're invested into. That's a significant risk, right? And those are the leading asset managers and investors in this region. And that's happening across the board. What we're seeing is less resource at a time when we've got more information to look at than ever before, and at a time where that information is being produced and developing at a rate that we've never seen before. So what we have here is, and that's both regulatory information and stakeholder information as well. So what we have here is a situation where investors are taking on board more risk, and we're trying to do more with less. The third contributing factor here is a lot of companies are still carrying a high level of, I would say, risk from the pandemic. So a lot of companies only saw their way through the pandemic by borrowing, whether that was short-term debt or long-term debt. And a lot of economists are now almost somewhat agreed that we are headed for some kind of credit event. The real question is when that credit event happens and how bad that credit event is actually going to be, right? So the consensus generally is that we are headed for some kind of event. This kind of situation, well, companies are now looking to refinance, right? So now looking to change their capital structure, try and refinance that debt that they borrowed over the pandemic. This is a strong incentivization for greenwashing. We're seeing corporate greenwashing in a number of different places globally. And from the conversations that we're having with a lot of asset and wealth managers and hedge funds across Europe, but also, again, globally, people are starting to try and tackle this as they're also realizing that this is a significant problem. So we have a situation where investors are taking on board more risk, we're trying to do more with less, and companies are almost incentivized to try and make themselves look better than they actually are. The fourth contributing factor here is there is very little consensus in the industry about how to implement and tackle ESG information, whether that's regulatory approaches or incorporating ESG into your financial strategies. There is not a huge consensus across the industry. So I talk to some of the wealth managers and asset managers that I talk to are either doing nothing from an ESG perspective, or they're still heavily reliant on ESG ratings. Now, I'm sure everyone in the room here can identify where the risks in both of those approaches are. And on the other hand, we have a number of investors who are going above and beyond to try and incorporate ESG across multiple lines of business. That gap, that delta, is where things are likely to get missed in this environment. And it's where, if things do get missed, a lot of investors and their clients are not going to be ready to deal with those issues. So what I'm not saying, I'm not trying to be the kind of prophet of doom here, but I'm not saying that we are definitely headed for some kind of negative event or a number of negative events. But the chances of something negative happening or series of controversies being missed and so on and so forth happening is significantly higher now than it has been in the recent past. Okay, so now that we've identified that we potentially have a problem, what are we going to do about it, right? Is AI the answer? Is it going to help us? So I'd like a show of hands for anyone here who thinks that that top horizontal line is longer than the bottom horizontal line. No one. Does anyone here think that the bottom horizontal line is longer than the top horizontal line? One person. Tough crowd, tough crowd. Skipping ahead. Does anyone here think that they're even? Okay, so I know that a lot of you are cheating here, but okay. If you weren't cheating and you didn't know the answer to this, it would be very difficult for you to have a high level of conviction in your response to that answer. And the reason is that I'm not giving you enough time, and I'm not giving you the resources with which you can come up here and measure these two lines. And that's exactly what AI is designed to do. AI is there to be targeted to whatever it is that you want to look at, whether it's internal minutes, whether it's company self-reported information, whether it's stakeholder reported information. it's designed to give you the time and the information from which you can make a factually based decision. And so as all of you know that these two are even, I'm guessing you also know that it is known as the Muller-Lyers optical illusion. And this completely fooled me, so yeah. So what I wanted to do here is put together a few case studies where we look at different scenarios of where AI can help. And the first is going to be on an aggregated basis. So when you're looking at a fund or portfolio, how can AI help? The second is going to be where an ESG event or an ESG risk plays out over a long period of time. How does AI help there? And the third is going to be, okay, in kind of those immediate controversies which play out over a very short period of time, ESG risk, how does AI help us in those situations? So from an aggregated basis then, what I tried to do here was benchmark the Lux index against the CAC 40. So both relatively small indexes and both European indexes. And there are two pieces of information that I personally, everyone may have a different opinion, but I personally am looking for when I'm benchmarking, right? The first is, okay, how is my portfolio, watch list, supply chain, or index performing against the benchmark right now? So what is it outperforming or is it underperforming? And that's a figure that we can see here on the left-hand side. So there's a 4% delta, a 4% difference between how the Lux index is performing and the CAC 40. But 4% isn't significant. I probably wouldn't spend a huge amount of time focused on that number. Where I would want to spend some time, however, is on a kind of more forward-looking basis, and I'm looking at momentum and how things are developing over time. On that right-hand side there, where it says 13.9%. So what that is telling me is that there is, right now, a 4% difference between them, and when I look at the momentum going forwards, that difference is increasing. So immediately, whether I'm a sustainability professional, an investor, whatever role I am in, I immediately know that there's something happening in the Lux index that is either causing it to fall further behind the CAC 40 or causing it to fall behind on an absolute basis. And so I need to spend some time immediately investigating, okay, well, why is that? What is it that is happening within this portfolio to cause this situation? Now, those two numbers in and of themselves don't seem hugely impressive, right? I mean, they're just two numbers. You've got 4% and 14%. But when you actually think about how you get to those two numbers, you need to, for 49 companies, look at hundreds of thousands of data points. You need to look at those data points in multiple different languages because they're international companies with large supply chains. You then need to aggregate that information. You then need to understand, for each of those data points, how is that piece of information going to impact this company? How does it interact with this company? And then you need to do that daily. Now, I'm sure there are many of you who are more efficient than I am in the audience, but doing that on a day-to-day basis is almost impossible without the help of some kind of AI or some kind of tool, right? So just getting to those two numbers which tell me that I have a problem is difficult if I don't have the help of some kind of tool. But then that's not enough, right? I need to know, okay, well, what's causing that difference? So on the right-hand side here, what I can see is that the Lux index is actually getting worse. And these results were taken about a week ago. But Lux index is actually getting worse on an absolute basis. And it's getting worse on an absolute basis on a number of different topics. So greenhouse gas emissions. It's getting worse from supply chain management. It's getting worse on product design and life cycle management. And a number of individual important topics. So I know I've got a problem. And just as importantly, it's getting worse compared to the CAC 40 by a significant margin. If you look at greenhouse gas emissions, you're seeing it fall behind by over 16%. That's significant. Similarly, for supply chain management, you're actually seeing it fall behind by 17.4%. So I know that there are places that I need to spend some time looking at. And AI here is not, again, it's not designed to tell me what to think, what to do, but it's just designed to tell me, okay, I can spend the resources that I do have looking at these particular topics, at these particular companies. And so AI here can look at vast amounts of information, pull it all together. It can tell me what is material, financially or not non-financially, and help me make maximum use of the resources that I actually already do have. Good. So hey, how can AI help me when an event or an ESG risk plays out over a long period of time? And I've chosen ESG risk for the next two just because it's quite an easy way to demonstrate the value here. But I've taken Bombardier as a case study. Now, I don't know if anyone's familiar with Bombardier, but they are an aeroplane manufacturer. And in Q4 of 2021, they lost a quarter of their market value in just 8 weeks. That's significant. The reason that they lost that market value was investors got nervous as a result of an investigation of potential corruption. Now, corruption is a type of ESG risk which plays out over a long period of time. It's rare that you look at an investigation and you see that there was just one corrupt event that led to that investigation. Typically what you find is that it started off small and then grew over a number of months and years, and then it snowballed, and then the inevitable happened, right? It was exposed. And that's what we can see here. Over the years, there were 360 connections between Bombardier and corruption. 360. And if you go back to 2017, what you would have found is on the 10th of March 2017, Bombardier came out and asserted its commitment to high ethical standards. So we're all happy, right? Great, ethical standards, love ethical standards. On that exact same day, officials of Bombardier were arrested in Sweden on bribery suspicion. This is happening all the time. A company will come out and say something, and the complete opposite is actually happening, right? Now, those two statements or those two events don't really add up. But as an investor, a human investor, or stakeholder, or sustainability professional, there's every chance that I would have picked up on that information. And there's every chance that I would have understood the context that that information was in. I can tell that, these two events or statements don't really marry up. But when you put it into the context of the equity price continued to increase, at the same time as the equity price increasing, what you had was you have a number of other companies to look at, a number of other stakeholders talking about potential risks or potential opportunities. And you have a number of other things to focus on. And that happens over the period of months and years. There you can see that there is a likely scenario that you're either going to forget that this happened, or if you don't forget, you're very likely to place less emphasis on this information. So AI, when a kind of ESG event or risk plays out over a long period of time, is really just there to connect the dots. It's there to be a reminder that this is still happening, right? No matter what the rest of the market, whatever other sustainability professionals are saying, this is still happening. And it's also there to tell us that we need to spend some time actually looking at this particular risk. So it flagged this as negative and told us that there's a high level of standout. This is an event with a high level of significance. It's not just a standard event that I can kind of skim over. I need to spend time looking at this. And so with that, it's helping us to connect those dots over a long period of time. But what about over a short period? What about when ESG risks play out over a number of maybe a few days or whatever it is? So here I've taken the example of Boohoo. So Boohoo is a fast fashion retailer, and they're a small cap company. So AI works across company sizes. And what you will have seen is on the 3rd of March 2020, Boohoo was linked to their workers wanting to unionize. Now that can be interpreted in a number of different ways, right? You may say that's a positive thing, you may say that's a negative thing. But whichever way you look at it, workers wanting to unionize is typically a sign that workers want something to change. Typically, they want better working conditions, maybe they want more pay, but whatever it is, they want something to be improved. So, in my eyes, that's a potential red flag. It's not a risk in and of itself, could be a good thing, but it is a red flag. Well, just a few months later, on the 2nd of July 2020, so the height of the pandemic in the UK, what you will have seen is Boohoo started to defend underpaying its staff and also forcing staff to work sick. In the middle of a pandemic, it was forcing its staff to actually work whilst they were sick, right? And actually paying less than the minimum wage. Now, obviously, that's a negative event. But what AI can do here is that can bring this to our attention as soon as it happens. So speed of access to information. And then it can also tell us that this is something that we need to spend time looking at. Again, directing the resources that we do have to where they need to be focused, right? We can't look at everything. We don't have those resources. So where do we need to spend that time? And just 3 days later, there was a £1 billion hit to the company's market valuation. Now, whether you're an investor, whether you are a sustainability professional, whatever your exposure is to Boohoo, there's a very strong chance that there's either going to be a reputational loss or a financial loss as a result of this. Your clients are going to ask, well, why were you invested in this company? So AI here is speed of access to information and a direction that things are important. And so tying all of that together and bearing in mind the conversations that I typically have, right? How can AI help us address some of the gaps in the approaches that we're taking as an industry towards ESG? Well, the first is that there is an over-reliance on company self-reported information. Company self-reported information is very important. We want to know what a company says about itself. You can't disregard that. However, companies are not going to tell you all of their spots and warts. They are inevitably going to be fairly biased. As objective as they say they are and they want to be, they're not going to tell you everything. And SASB itself actually wrote a letter to the SEC a few years back where they found that 90% of ESG risks are not disclosed by a company themselves. That's a significant problem in the context of where we are financially and from an ESG perspective. So there's a fairly easy solution to this, right? You look at other sources of information. But as we've seen, looking at other sources of information significantly increases the amount of work that you have to do, right? At a time where we just don't have the resources to do that. So this is where AI can come in. It can help you look at those alternative sources, whatever that is, whatever the use case, again, regulatory, whether it's climate, it can help you look at those sources of information and collate it for you, to give you a kind of more objective 360-degree view of what that company or entity is actually doing. The second thing that I see a lot of is a reliance on ratings and information that is typically updated either on an annual basis or sometimes even slower. So, I mean, ESG ratings, typically updated annually, but I've seen instances where an ESG rating hasn't been updated for like 4 or 5 years. That's fine if you're an academic, right? If you're doing a long-term piece of research and you want to understand kind of, trends and things like that, maybe that's sufficient. But if you're an investor, if you're a sustainability professional or a stakeholder in a company, you want that information to be up to date when you're looking at it. So AI here can help give us this information in almost real time. It can collect that information in real time. The third thing I see a lot of, and this can sound quite rich from someone who's just spoken about ESG risk for 10 minutes, but the third piece of information here is an over-focus on ESG risk. And ESG risk is, of course, very important, right? But it's very difficult to understand and contextualize an ESG risk if you're not also looking at what a company or an entity has done and is doing to mitigate some of those risks. And so here, what you need to look at is, okay, well, what are their policies? Are those policies effectively implemented? Or are they just policies for the sake of marketing and kind of, green marketing? And then what you need to do is make that association. You need to understand, okay, well, how do these policies actually mitigate this potential risk? And how do these things interact? That's not easy when you're looking at a lot of data points, when you're looking at a lot of companies, and you just don't have the resources to keep up with that in kind of real time, right? So AI here can collect that information for you again, and it can help you understand, okay, does this information mitigate this risk? Does it not? Is this risk still a problem? And the fourth gap that I see very often, and this is probably the hardest to solve, right, is the so what. So we can all sit here and say, okay, well, we're collecting, how much greenhouse gases a company emits, how many women are on the board of a company, and other kind of very important pieces of information. But what do they actually mean? What does that actually mean? So what, right? So you know how much a company is actually emitting. What does that actually mean? AI is there to help look at all of these pieces of information, identify trends, help you understand what is most material right now, either from a financial perspective or a non-financial perspective, and give you that nudge towards where you need to be looking at, so that you can connect the information that you're seeing to what is actually happening in the real world, making that connection. Now, AI is not going to fix every problem in ESG, it's just not. But at a time where we are potentially heading into, or already in, this kind of perfect storm, and at a time where there is no consensus on how to approach regulation, how to incorporate ESG into our financial strategies, AI can help us bridge some of these gaps and make missing something quite less likely, or help us deal with something when we do miss it. But obviously, I've stood here and spoken about how great AI is, but what are the limitations, right? What is it not useful for? What do we not want to use it for? So the first limitation is there can be biases in both the models and the data. So much like us, we all have our own biases. It's very, very difficult to systematically or eliminate bias systematically in your AI models. Not impossible, but very, very, very difficult. Similarly, the actual information, so those sources that you're ingesting and putting into that tool may carry bias themselves. If you're looking at articles, journalists are ultimately incentivized to write about things which are going to grab people's attention, right? They're going to use language which is designed to grab our attention. So there could be bias within the actual piece of information that we're looking at. Internal minutes, are they disclosing everything that was actually spoken about? Is it recorded accurately? So on and so forth. So bias is a problem. The second is that context can be tricky to infer. So you and I can look at a sentence or a paragraph, and we can understand that that paragraph is talking about a dog, even if a dog isn't mentioned in that paragraph. And the reason is that we can infer context. AI does struggle with this. Now, there is a kind of subset of natural language processing, which is called natural language understanding, and that is designed to kind of fix and solve some of this. Institutions like MIT are putting a lot of effort into solving these kind of problems, but we're not there yet. We're not at a stage where an NLP tool can read and understand spoken language in the same way that you and I can. And the third limitation is low resource scenarios. So for example, in Africa, there are between 1,200 and 2,100 local languages spoken. There is a lot of valuable information, I'm sure, being written or spoken about in those languages. And yet, very little of that information actually makes its way into the hands of those who are designing NLP tools or training those tools. And so AI does have a limitation in certain markets. So for example, frontier markets, it's probably not going to be the most useful thing to kind of help you gather and analyze information. Similarly, in smaller emerging markets, there's a kind of gray area as to how helpful it can be. But by far and away, the biggest limitation, and going back to what I was saying earlier, is we still need you. AI is not there to tell us what to do. AI is not going to become an ESG analyst. It's not there to make a conscious decision as to whether a fund is or is not Article 8 or Article 9 compliant. It's only there as a tool to gather the information, to collect that information, and give it to you in a way that helps you use the resources that you do have to kind of most effect. So using your experience, your intuition, and your knowledge to kind of make those decisions. So with that, I will turn over for any questions. And only easy questions are allowed.
Hello, thank you for the interesting presentation. I had a question on when you mentioned, I think it was the Bombardier example, that you have a positive sign and a negative sign on the same day. How do you actually value both? And does it link with what you said, that you take whatever is self-report with a pinch of salt? So does it take a lesser amount of importance in the analysis? Thank you.
Sure, so that's a great question. FactSet's tool itself only focuses on third-party stakeholder information, but I'll answer the question from a kind of removed perspective. So yes, a tool could, in theory, and this is something which some asset managers, particularly in the UK and US, are trying to kind of build internally, is a tool that looks, or a model that looks at both company self-reported information and third-party stakeholder information, and trying to understand how the two mix together, right? The way that we do it is when we're looking at this third-party information and we get a positive and negative signal, if you will, on the same day. What we're actually doing is we're looking at a company's history. And we're trying to understand, okay, well, given every single one of the X amount of companies that we cover, how does this fit into how does it fit into their history? Is it a surprise event? So surprise events financially and non-financially have been proven to have a bigger impact. There's quite a lot of literature around that. Or is it a continuation event? Has this company always had a problem with corruption? And so when you look across a company's history and you look at their exposures, how they've dealt with corruption in the past, has that been a long-standing problem? Is it something that you can expect of a company of this type? And when we're talking about type, we're looking at size, industry, locations of operations. Is it something that company, given that, is actually almost expected to have, even though it's still a negative event? And then we're trying to kind of come up with the end result, right? So much similarly to a human analyst, would look at that information and say, oh yeah, but Bombardier, and I don't know if this is true, but Bombardier have had corruption issues for the past 10 years. I don't think it's going to actually have a financial impact. And this is a known ESG risk. So trying to put all of those pieces of information together and give a kind of tangible flag at the end via a score or via our dynamic materiality model, which tells you and directs you as to what is material and what is not a material risk, and directing you towards that. But the actual calculation of that is very complex. There's a huge number of factors that go into that historically and at the moment. I hope that answers your question.
Is there any other question?
I was just wondering how FactSet, or what the approach is in terms of trust or explainability of the models. Is that something that you sort of account for? Is that something that clients ask about? And sort of what is your, I guess, philosophy around that?
Yeah, so this is one of the, going back to those two reasons why people don't use AI, right? I suppose the third implicit reason is that a lot of people don't want a black box tool. They don't just want, particularly when it comes to AI, people don't want to trust a score or a rating or, a signal saying, whatever. And this is not just in ESG, but it could be anything. They don't want to trust the outcome. Similarly, you could also compare that to human equity research analysts, for example, which gives a buy, hold, or sell rating. People don't just want that. They want the kind of body of text underneath that says, this is why I think this company is a buy or whatever. So the way that we deal with that is we explain and break down every single score, if you will. So we have that dynamic materiality piece, which tells us, okay, in reality, where is this company's exposure? And at a very basic level, the way that we're doing that is volume of information. So we work with a lot of academics, and it might sound simple, but the more that stakeholders talk about something, the bigger the impact it's likely to have, financially or non-financially. Makes sense, right? From a financial perspective, 90% of a company's valuation is intangible, so reputation is a big part of that. We then tell our clients what is actually changing all of those scores and how that is calculated. But at the end of it, a lot of our clients don't trust our scores. They don't want to rely on our scores. As much effort as we put into saying, okay, this is accurate or it's not an accurate representation, really the reason that a lot of people use this kind of AI tool is the underlying ability to identify that information, collect that information, in some ways aggregate those into what we need to look at, and doing that in a kind of easily accessible format. Thank you.
We have actually two questions from WebEx.
Okay.
So the first one is from Anthony Smith-Meyer, and he particularly appreciated your presentation. He also says that he found it particularly insightful, and he is asking how wide can one spread the monitoring of companies for ESG risk, integrity, or broadness of scope? Can you cover large numbers of companies in a given portfolio, or are there limitations? Can it reliably highlight cases of ESG washing or rank companies by ESG performance? So there are several questions, but we only have a couple of minutes. So.
Okay, all right, fine. So I'm going to merge all of those questions into one and probably miss everything. So the easy answer is, as long as your tech stack, so the technology behind what your tool actually is designed on, is big enough and sophisticated enough, you can look at the whole world of companies. So we look at 240,000 companies, split between private and listed companies. So as long as those companies are within that universe, yes, you can aggregate them into whatever you want and look at all of those companies. I've already forgotten half of the question. But in terms of how you rank those companies, so again, this is one of the biggest criticisms that I see and hear about ESG ratings and AI tools as well, is that largely vendors are focused on comparing within the same industry, right? That can be useful. The problem with that is comparing two companies in the same industry when one is, let's say, in India, the other is in the US, and one has 10 employees and the other has 10,000, is ultimately going to skew your ESG view when you're making direct comparisons. So as long as you've designed your AI tool to do this, you can benchmark by industry, size, locations, and so on and so forth. So just one interesting piece of research that we did was we looked at the telecoms market and companies of a similar size in the US and Europe. And what we found was that companies in the US had a significant problem with data privacy or data security. Probably not so surprising. In Europe, we did not have that same significant problem. And the reason is GDPR. Right? So you have to take these kind of factors into account when you're actually looking at kind of ESG exposure across the whole spectrum.
Thank you very much. Thank you, Fabrizio, for your insightful presentation. And just for you, our next session will start at 12, so we have just a couple of minutes, and will be hosted by Ada. And thank you very much again, Fabrizio. Sorry.